Okay, we're going to start talking about money, and we've already kind of gone over these, but any object that is accepted for payment, services, or repayment of debt is considered money. Three functions of money. It's a medium of exchange. We're able to use it to exchange for goods and services. Otherwise, we'd have to barter or trade. Use it as a unit of account, which means it provides us a way of putting a value on something by looking at the price. And then a store of value, we can store it for later, we can put it in a bank, we can put it in a wallet. 6 characteristics of money: durability, so it can withstand wear and tear; portable, you can take it where you want to go; divisible, a dollar can be broken down into 4 quarters or 10 dimes, etc. Uniformity, it looks exactly the same, and also every $1 bill is worth the same. We have a limited supply. If we had too much, it would decrease its value, so we need to keep control of the supply of it. And acceptability, everyone must be able to accept it as money. The sources of money's value, two different things here. The idea of having gold or silver, which is specie, back your money, and that's called representative money because the piece of paper actually represents a certain amount of gold and silver. So you could take that piece of paper to the goldsmith and exchange it for that particular amount of gold or silver. Then the other is fiat money, and a fiat is just a government decree. And the fiat money is legal tender, and it has value because the government has decreed that it has value and that it is acceptable to pay your debts. To talk a little about banking and history of banking just a little bit. National Banking Act of 1863 and 1864 were extremely significant. It gave government the power to charter banks. It also required banks to hold a certain amount or an adequate amount of reserve of gold and silver to cover all the banknotes that they had out in circulation. And what it also did is it started to get us to the point where everyone is using the same currency. Before this, states were issuing their own currency, and so we had hundreds of different currencies out. The gold standard. Because of the years of problems with money, the United States actually adopted what was called the gold standard. And the gold standard was a monetary system where all of our paper money and coins had a value of certain amounts of gold. It wasn't 100%, but it was a certain percentage. So governments could only issue currency if it had enough gold in the treasury to back those notes. Because of the limited supply of gold, the government was prevented from printing an unlimited number of notes, so that really kept control of the money supply. In 1913, we get the Federal Reserve Act. And what the Federal Reserve System is, it's also known as the Fed, and it really is the nation's first true central bank, and it becomes in charge of monetary policy, which is basically the supply of money. A couple things that it did: it created 12 regional Federal Reserve banks, and all banks that had a national charter had to join. State chartered banks could voluntarily join if they wanted to. It also created a Federal Reserve Board, and the board is appointed by the president. It was able to give short-term loans to member banks, and this idea of the uniform currency through the Federal Reserve, through these Federal Reserve notes. I just thought this was an interesting little story that I read. After the Great Depression, there was a banker who was being overwhelmed in Minneapolis, or in Minnesota, and he calls the Federal Reserve Bank and warns them that there is this run on the bank, and that if they don't get there soon with some money, that he was going to go out of business and it was going to fail. So what happened was they flew $500,000 in small denominations to this town, and the pilot flies very low over it so that the people could actually see that they were coming. Lands at a nearby field, and they escort all of this money into town, and they stack all this money, $500,000, in front of the teller's window, which kind of helped with the customers' fears, and it saved eventually the bank from failing. Some more about the Federal Reserve. It is privately owned by the member banks, but it is publicly controlled by the federal government, and it has a Fed chair who is chosen by the President of the United States. Ben Bernanke is currently the Fed chair, and he was appointed by George W. Bush in 2006, but he has been reappointed the last 2 terms of Barack Obama, who is currently in the process of looking for a new Fed chair because Ben Bernanke is going to retire. Here is a map of all of the 12 district banks, and if you notice, we're up here. Indiana split into 2 different districts, but the northern half is in the 7th district, the 7th Federal Reserve District. The Federal Open Market Committee is the committee that is in charge for making decisions about interest rates, which ultimately leads to the increase or decrease of the money supply. Functions of the Federal Reserve: they are the bank for the government, so they are the actual checking account for the U.S. Treasury. So if you get a government check from the federal government, a Social Security check, any type of tax return, that is from the Fed. They issue currency. The U.S. Mint makes the coins, but the Federal Reserve banks are the one who make the paper money. They're also responsible for check clearing. So all of the checks that go through the United States, they are the ones that are responsible for clearing those checks and keeping track of the accounts where the money is going in and coming out of. And then the banker's bank. If a bank needs a loan, they can loan each other money. Banks can loan each other money, but then they can also get a loan from the Fed. And the discount rate is the percentage rate of interest that a bank has to pay to the Federal Reserve. So that's the interest rate that they'll oftentimes announce as the discount rate, because if a bank has to take a loan from the Federal Reserve, then they're going to actually have to charge their customers a little more money in terms of interest rates. Talking about the money supply, there are 3 different definitions of money. The first one is M1, and that's equal to all the currency, coins, and demand deposits, which is the same thing as checkbook money. You need to think of M1 as the money that you can actually spend. You can take cash, you can take coins, you can take checkbook money to a store, and you can actually purchase something with that. So M1 is all of the actual money that we have out that we can spend. M2, you have to take M1, and then you're going to add to that savings deposits. So anything in a savings account. We actually cannot take our savings account books to the store and use anything to purchase, but we can get to them very quickly. We can get them out with a debit card, or we can transfer the money online and put it right into our savings account. So savings deposits, you add that to all your currency, coins, and checkbook money, and that gives you M2. M3 is actually the largest definition of money, and it includes all of those things we just talked about, plus large long-term deposits. If you have a certificate of deposit, usually what they require is for you to put thousands of dollars in this, and they also make you keep it in the bank for a certain period of time. So these large long-term deposits, if you take it out before then, you're going to pay a penalty, which means you're going to not get any of your interest probably, or they are going to not give you any interest, plus they're probably going to charge you part of your principal also. The Federal Reserve controls the money supply in a couple of different ways. The first way is through interest rates. The higher rates encourage people to save, less money in circulation. Lower rates encourage people to actually spend money, which gets more money out in circulation. The reserve requirement, which is the percent of money banks are required to keep in reserve, also has an effect on how much money is out in circulation. Higher reserve requirements, that means the bank has to keep more money in the bank and reserve. That means there's less money out in circulation. Lower reserve requirements mean there's more money out in circulation. And the third way that they can manipulate the money supply is through the buying and selling of U.S. bonds. If they buy bonds, they are putting more money out in circulations. They are taking more bonds out, putting money in the hands of bond owners. If they're selling bonds, they're trying to get less money in circulation. So you have the bond, but they have the cash. Couple of banking crises. First one, the Great Depression. A couple things lead to the Great Depression, and that is some very large loans to some high-risk businesses that went under and they could not repay the banks. During this period of time, farmers were having hard times, and so a lot of these large farms were unable, even small farms, were unable to pay back the banks. And then obviously the stock market crash leads to bank runs where everybody's going to the bank and wanting to pull their cash out. And if everyone did that, obviously the money is not there because it's been loaned to other people. The most recent crisis in 2008 was due to the subprime loans. These are high-risk mortgages, and a mortgage is just a home loan. Um, People paid very high interest rates for these particular loans, and they really went after low-income people who did not qualify for a traditional loan. And so they preyed on these people and got people into homes that really couldn't afford and shouldn't have had them. And then what the banks did with these is they bundled these mortgages together and sold them to investors, because these investors are thinking people are going to pay their loans back and they're going to make some money off this. But actually what happened is it created a housing bubble. People were buying multiple homes thinking they could flip them, which just means they would hold on to them for a while and then they would sell them for a higher price later on. And so you had all of these homes out there, and then when the economy goes down, the value of the homes go down. And then when people tried to refinance them, the homes were worth less than what the loans they currently had. And so they couldn't get a new loan for these large mortgages that they had out. So this was a complete mess, and we're still paying for that today.